Today, Costa Group's in the news this morning as the American PE firm Paine Schwartz reduces its non-binding takeover offer for shares it does not already own, valuing the horticultural company at just shy of $1.5 billion. Of course, we've been talking about AFL and Costa Group, Frank Costa's family company that listed. Frank Costa, the former president of Geelong for all those years. Under the proposal, Costa's shareholders would receive $3.20 apiece for the remaining 85%, taking PSP, the stake PSP does not already own, lower than the $3.50 apiece offer received in July. Now, Costa is considering the lower bid and is continuing to engage in the PE firm regarding terms and conditions. The company ASX announcement notes that shareholder action is unnecessary at this time, or is it? Let's hear from the panel of experts now. David, what do you think of Costa's announcement? And if you're one of the 85% that haven't accepted the offer, what should you be doing?
Oh, I'd be holding in there at the moment. I think it's certainly probably not overly surprising that the bid was reduced, given that there's been due diligence happening and Costa, in its result, actually announced a $30 million write-down or loss as a result of some of the issues that they've had with their oranges. So it is a business that is very obviously subject to agricultural and environmental conditions, and their oranges have suffered due to the fact that 2022 was a very wet year. The positive on the side of the company is actually their international business. So they've actually been growing blueberries in China and Morocco, and that's a part of the business that continues to bear fruit, pun intended.
Boom, boom.
But yes, certainly disappointing, I guess, to see the price reduced, but they are still interested in buying the business. They've currently got just shy of 15%. Our valuation on the stock without the bid is $3.10. Prior, when the previous bid was at $3.50, we had a valuation of about $3.40. So our analyst had attributed about a 75% chance of that bid going through. After today's announcement, I suggest that they might be having another look at that number, and perhaps the valuation comes down to closer to our $3.10 or even that $3.20 sort of figure. But we've got a hold on it. So if you've currently got stock in it, I'd be holding.
Right.
But yeah, it's
okay.
a bit disappointing.
So it's 284 at the moment.
That's right.
Yeah, Daniel, what would you be doing?
Yeah, look, certainly I think if you're in the stock, you're holding it to see what the outcome of the bid will be. Obviously, I don't think the board has given a recommendation, like you said, Koshi, on the updated figures, but certainly, it's not a great sign that you had, a revised offer lower when the previous offer, on a multiples and on a valuation basis probably wasn't, too much of a premium at all, especially when you look at where the share price has traded historically. So I think it is a pretty good indication of some of the struggles at the moment within the business. And like David said, I think some of the international assets, especially that blueberries partnership I think they have with Driscoll's is certainly, an area of great returns. But outside of that, it has been difficult. And I think there's been acquisitions made since the business relisted, which has probably come back to haunt them a little bit. And, with agricultural assets, they can go through periods where, if they're not performing, they do get written down significantly. And it's just very hard to get sentiment and interest back in a stock like this. So, we typically don't really like to venture in to the agricultural space too much. There's always difficulties there. And, if you're in the stock now, you're probably not happy with the revised offer. Doesn't look like there is much of a premium at all. So you'd rather kind of wait it out, because it's obviously one of the better positioned asset bases out there for its sector. And, over time, you'd expect the cyclical factors to change and the stock to benefit. So, you'd probably be waiting in there. And at this kind of revised lower offer, you probably wouldn't be too happy with an acceptance, I think.
Yeah, okay. So hold on as well, the same as David. So Daniel, you steer clear of ag stocks, and David, what about you? Do you steer clear of them as well? Because it's companies find it hard enough to get consistency in earnings, but when your orange crop drops because of the weather that you've got no control of, they are a roll of the dice sector, aren't they?
Oh, they are. They're definitely subject to the weather, and we've seen around the world a significant increase in bad and very destructive weather. So that's definitely a risk that they have. I guess in the case of Costa and other big businesses, they're better placed to ride through some of those issues than some of the individual farms themselves. So we don't steer clear of it, but you need to be aware of those risks. Another stock that we like in the food business is Ingham's. We think that they're very well placed. So yes, it's an area that there's definitely a lot of demand, a lot of long-term growth for, but you need to be aware of the risks.
Daniel, when you look at this sector, do you figure into your filter that there's got to be a much higher margin for you to actually invest there to offset the risk?
Yeah, look, I think mainly with agricultural businesses, Koshi, a lot of the times they're probably based on mostly like a valuation basis in terms of what the net tangible assets are worth. Like I know if you look at even a company like Rural Funds, obviously they don't operate all of their farmland, but they do operate across a significant amount, especially in some of the orchards there. Like, the reason why you invested that is probably an asset play, right? And with Costa, obviously that it is more of an asset play. Even companies like Cobram Estate, which we looked at a few weeks ago, the reason why you'd be interested in that is probably an asset play as well. So rather than an earnings multiple, and even, in the private world, when banks lend to agricultural companies, they don't look at, say, a point in time period of earnings. They'll have a rolling forecast and a rolling historical basis to compare it on. And it just doesn't translate well to public companies because the market is always so focused on, a 6-month period or, what's the next earnings hit going to be? And these types of businesses, as we know, they're multi-year cycles and, they just don't translate well to listed markets. And obviously there's periods where that could create opportunity, but you just need a lot of specialist knowledge and
so almost you treat them like a REIT. You forget the business side of what they're growing. You just pay what the land's valued at.
Yeah, you can, but you have to be careful because not all agricultural companies own the land. A lot of them are leased, especially ones that kind of go through private equity and they get the land sold and then relisted. So you really have to understand what's going on at the balance sheet. We haven't taken too deep of a look at Costa. Obviously, it's gone through private equity multiple times. So you really have to understand what's going on there at the balance sheet level.
And that's always a bit of a red flag when the PE firms have got stuck into them. All right.